With the Nifty recently shooting past 21,500 and making new lifetime highs, there's one set of people who are really unhappy. Those are the people who don't have even a single equity investment. If you miss this bus, or should we say rocket, the feeling can be quite terrible. If you don't act today and you stay on the sidelines, you find people all around you making money while you don't. If you jump in on an impulse and take the plunge, who knows with your luck if the market corrects sharply and you lose capital on your first equity investment. Systematic investment plans or SIPs are invented exactly for this kind of situation. In this question of money video, I, Aarati Krishnan, will be telling you how you can invest if you missed the rally so far in the equity markets. For people who have no equity investment at all, there are 4 things to do. Avoid investing directly in stocks even if you are tempted to do so. Why I am saying this is, when the markets are going up, if you are new to markets, investing in the right kind of stocks requires a lot of research. But when the markets are zooming so fast, you can get tempted to invest quickly. This will mean investing on somebody's tips. In a market like this, if you rely on tips to invest, typically you will be picking up the stocks which have already gone up a lot and are market favorites. Now, when a crash follows a bull run, usually the stocks that have gone up the most also fall the most. It is possible for individual stocks actually in a correction to fall 70 or 80% also. If you have such an experience on your first equity investment, you will never come back to the stock market again. This is why investing in a mutual fund is a far better proposition, because a mutual fund invests in a basket of stocks. When you invest in a basket of stocks, the fall tends to be cushioned and you will not suffer the kind of losses that you can suffer on individual stocks. Secondly, a mutual fund is managed by a professional fund manager. So if there is a market correction, actually he will be replacing some of the overvalued stocks with the more attractive ones. He will be refreshing the portfolio. Therefore, the extent of loss that you experience will not be so high as with individual stocks. If you are not sure what kind of investment you should make or what kind of equity fund you should buy, simply go for an index fund. We have index funds which invest in the basket of Nifty 50 stocks, Sensex 30 stocks, or even Nifty 100 stocks, which is the top 100 stocks in the market. Now, why do we advise this? Because selection of the fund becomes very easy, and these funds typically invest in large cap stocks. As we told you in a previous video, large cap stocks tend to fall much less than mid or small caps in the event of a market correction. Instead of investing a big lump sum in that index fund, sign up for a systematic investment plan or a SIP. Why do we say this? If you invest a large lump sum in a market peak and a correction comes, you can lose a lot of that money. Now consider people who invested in January 2008, which was the previous lifetime high for the Indian market when the Nifty was at 6,200 points. In the very next year, the market crashed a lot and the Nifty went down to 2,800 levels or so. Now for new people who are in the market, losing this kind of money can be a terrible experience, and you can actually sell at this point and exit the market in a panic. If you exit the market at that point, you never have a chance of recouping that money. Whereas people who held on through this bottom actually and stayed on till date, they would have made a comfortable 9% annual return on the Nifty investment till date. When you invest a lump sum, especially as a newbie, it can be very difficult to hold on through such corrections. Whereas when you invest through a systematic investment plan, you phase out your investments over time and therefore you do not feel the impact of the crash so much. This is exactly why we recommend that newbies stick to systematic investment plans for their equity fund investments. Suppose you have 1.2 lakh rupees to invest today. Instead of putting the lump sum into an index fund, we suggest you spread it out over the next 12 months by signing up for monthly SIPs. Each month you will be investing 10,000 rupees. Now suppose after you start investing there is a big crash in the market, you will not have to worry because you will be investing at lower levels as well, and in the long run you will make a higher return on these investments. What if the market never crashes and continues rocketing like this? No problem. Then your SIPs will still continue to go in at higher market levels. At least you will not be missing out on investing totally and regret it later. So what happened to those unlucky souls who started their SIPs in January 2008, the previous market peak? Well, they have not done so badly for themselves, because today their 1.2 lakh will be worth 6.6 lakh rupees at today's prices.